Well, we have an amazing guest with us today, Daniel Lacalle. He is the chief economist at Tressis. He's a PhD economist. He's a best-selling author of many well-respected books. He's a fund manager as well. So, David, I'm really happy that you've come on the show today, and I'm really looking forward to discussing many things that need to be discussed throughout financial markets, the global macroeconomy.
Hi, thank you very much. Thanks for having me.
Absolutely. So, real briefly, can you explain the mechanics behind quantitative easing?
Okay.
Yeah.
I think it's simpler than it looks. Quantitative easing basically aims to incentivize credit in the economy. So what it basically does is that the central bank purchases the lowest risk and highest quality assets from the banks. So that means purchasing sovereign bonds, purchasing um, mortgage-backed securities, things that are of allegedly the highest quality and the lowest risk. And by freeing up those assets out of the economy, out of the balance sheet of banks, these and investors are incentivized to lend more, are incentivized to take more risk, and there's a general perception of what is called the wealth effect. So you make the sovereign bond very expensive, yields come down very aggressively, so the less risk inclined investors will buy assets that are slightly riskier, and basically tries to provide both confidence and a higher level of credit in the economy. That's basically the mechanic. So the central bank works exactly like almost any other bank. It has its balance sheet with some capital, and then it gets some assets that it purchases. It leverages the balance sheet by purchasing those assets. Hopefully, if they are right and they are the lowest risk and highest quality assets, they will go up in value and they will also generate an income, and therefore the balance sheet of the central bank will be stronger, and hopefully as well will be reducing as GDP goes up. That is the mechanic, and that is how it's supposed to work. It does not necessarily work that way, but that is the mechanic.
Right. Absolutely. I see it as a sort of reserve asset swap where
Yeah.
from, like you said, from the commercial banks to to the Fed, and somehow the treasury general account is involved, but on the fiscal side. And I believe, correct me if I'm wrong, also that's at 1.6 or so trillion dollars. So $1.6 trillion for Janet Yellen to spend upon, a lot of money left on the table to do fiscal spending.
Well, that is basically the idea, no? Quantitative easing started from a view of mispricing. So the Federal Reserve members at the time perceived that the market was mispricing sovereign bonds, that they were giving them too high a price, too low a price, too high a yield. That the yield of sovereign bonds was unjustified, and therefore what they did was, let's purchase those assets that are a burden in commercial banks' balance sheets, and in which there is an allegedly unjustified view of too much risk. We take those assets, we know that they're not risky, they will go up in value, and the economy will start rolling, credit will flow into the real economy, etc. Then it becomes what you just mentioned. Now no one can say that when the Federal Reserve purchases treasuries or mortgage-backed securities, that they're purchasing them at an extraordinarily low price or an unjustified weak valuation. What they're doing now is that they continue to put those assets in their balance sheet, hoping that fiscal policy will drive GDP higher, and that the incentives to pump the economy further will be stronger. And I think that we've gone from a view. I remember when QE started talking with some friends at the Federal Reserve saying, treasuries are a steal at these prices, to, okay, they might be expensive, they might be even overpriced, but if we allow those assets to be in the balance sheet of the central bank, and fiscal policy plus higher lending drives the economy higher and unemployment lower, then it will have almost the same effect.
Absolutely. The lack of and speaking to that, the lack of lending growth, throughout these commercial banks, does that attest to the fact that, within this low interest rate environment, is that why we see a lack of lending growth today?
I think that the problem is not that there is lack of lending growth. There is lending. Is that there's a saying that says that you can lead a horse to water as much as you want, but if it's not thirsty, it will not drink. No, so it's not lack of lending growth. It's lack of the kind of lending growth that the central bank or the government would want in order to drive GDP higher. But if you look at the reasons why credit growth is not as high as central banks or governments would want, and the reason why, therefore, we call this a liquidity trap, in which the central bank pumps liquidity, it does not flow through into higher credit in the transmission mechanism of monetary policy, and it becomes an almost self-fulfilling negative prophecy. But the reason why there's not so much credit growth as the central bank or the government would want, not that there isn't, is precisely because the policy of very low rates and high liquidity perpetuates overcapacity. So the slack in the economy that exists previous to a crisis prevails. And therefore, when the economy comes back to growth, the level of credit growth is lower, simply because, think about it, you have a business, your competitor has access to tremendous levels of liquidity and very low rates. Even if they're not competitive and not doing very well, they're going to continue to survive. And therefore, that doesn't lead you, as a more efficient competitor, let's imagine that is the case, to drive higher credit, to invest more, to hire more people. So the zombification is the sort of collateral of expecting a transmission mechanism of monetary policy that is not adequately analyzing what drives credit growth.
Very interesting. And you brought up the term zombification, which I find is very fascinating, because I haven't checked recently on data pertaining to it, but quite some months ago, I checked something that we've had more zombie companies in this period in 2020 than we've had, more so than the internet bubble. Just companies that they're essentially blank checks. They're paying debt with more debt. So they're not necessarily a cash flow positive kind of corporation. So can you attest more to that kind of conception?
Yeah.
Why are we seeing so many businesses, over levered, pre-pandemic and currently,
Yeah.
aside from the low relative interest rate environment?
Well, I don't think that it's just a coincidence. I think that there's a little bit of design here. Let's think about what a crisis is. No, the internet bubble and the burst of the internet bubble drove the current wave of technology disinflation and improvement that we all enjoy. No, so
Right.
thanks to the collapse of so many companies that had a wrong strategy in the internet bubble, today we have what I call the global broadband. No. Now, if when governments and central banks try to prevent economic cycles, they try to reduce the risks of a crisis, but they also prevent the positives of a crisis, which is the cleanup of the system, that the inefficient fall and more efficient buyers will arrive and take that company and do things better. So in almost a perverse way, by not understanding that the problem of the economy is not necessarily one of liquidity, but one of solvency. What ends up happening is that you're basically bailing out with high liquidity and low rates those companies that that would have not survived because they've done things incorrectly in a normal environment. I was speaking with my students the other day, and I said to them that in the current environment, with the current policies, Enron would have not collapsed. Enron would have not collapsed. Enron would have basically issued massive levels of debt and probably raised capital in a booming market and continued to drive that monster cash flow destruction machine for a few years further. Think about it. What drove Enron and WorldCom and other inefficient players down to the ground, and with them the improvement that we saw afterwards in terms of productivity, in terms of technology, in terms of business management, was precisely the fact that they were not bailed out by low rates and high liquidity. In any case, I think that it's a very thin balance. It's very difficult. The problem of top-down policies is that the central bank obviously does not want zombification, right, but the central bank is basically you're basically flooding the economy with liquidity. You cannot just cherry pick who is going to benefit from that liquidity and who's going to lose from that liquidity injection. Therefore, by monetary policy fundamentally benefits primarily the first recipients of money. So you basically inject liquidity. The first recipients of money are the ones that benefit the most. Who are the first recipients of money? Sovereign issuers and companies that already have access to credit and to capital markets. Who are the losers of liquidity injections? The new companies that don't get a loan despite the massive liquidity injections and the low rates, the small and medium enterprises that don't need loans, that work on cash flow, so it creates that perverse incentive, not because they want to, but because of the design. When the liquidity injection is designed to benefit governments, sovereign issuers, it will inevitably generate zombification, because it will, after governments, the ones that get the highest level of benefit and the ones that are the first recipients of money are the large zombie corporations that have been in stagnation for a long time, that are generating revenues. They don't pay their interest expenses with operating profits, which is what zombie company means, because those are the ones, it's interesting. And funnily enough, what you see is that those are also the ones that in the debate in Europe or in Japan tend to be called strategic companies. No? So you basically perpetuate overcapacity, and that leads to weaker productivity growth. Therefore, real salaries don't increase, or don't increase as much as they should, weaker growth itself, and weaker recovery of employment. That is normal, because basically what you're doing is it's a massive bailout of the indebted and the inefficient.
Right. And it seems to me that so many other sovereign nations, when analyzing the United States, for example, you have China from 2016 till currently, their treasury holdings have just simply declined.
Yeah.
And that goes for many other nations as well, holding US treasuries. What's the explanation for that front? Are these nations seeing uh, other collateral elsewhere that's, just simply more feasible to carry?
No, not necessarily. I think that what they're seeing basically is that they're what we're living is basically what one would call a currency war, in which um, nations don't try to have a strong currency, but try to have a weak currency in order to create false competitiveness. No, therefore, many countries, instead of adding treasuries to their balance sheet, because remember that treasuries in the balance sheet of another country are assets, no? So, and instead of adding those assets, they prefer to have less high quality assets. They prefer to have less reserves in order to drive their currency artificially lower.
Right.
So it's not because they don't trust the U.S. government or because they don't see the U.S. Treasury as a low risk asset. Because if that were the case, China would not have 3.2 trillion. No?
Right.
It's basically that they in this race to see who makes the neighbor poorer, the beggar thy neighbor policy. They almost, well, not almost, they willingly have less reserves in their balance sheet in order to try to avoid their currency from strengthening too much.
I see. Understood. And in terms of the US dollar, what is your outlook? And this pertains to everything we've discussed. I mean, how many dollars will somebody use tomorrow versus yesterday? I think that's a very legitimate question when looking out both the near term and the long term.
Yeah.
Is somebody's purchasing power really at risk here?
Well, I think that obviously there's a big difference between the Federal Reserve and all other central banks globally. The first one, the big difference, and I've had the pleasure of working with members of the Federal Reserve and governors of the Federal Reserve in the past, is that they pay attention to the global demand of US dollars. And the Federal Reserve works almost like the song Waiting for My Man, the Velvet Underground. Huh? He's always late, no? He's never early, he's always late.
Right.
They always issue less US dollars, a little bit less US dollars than the global demand. And when they issue more, and when the money supply of the United States grows above demand of US dollars, what tends to happen is that emerging economies fall into the trap and then increase massively their debt in dollars. And therefore, what they become is more dependent on the US dollar, not less dependent on the US dollar. That's why every time that there is a wave in which you see the dollar index weaken or the trade weighted nominal dollar traded index, no, the trade weighted index of the US dollar, you see that it weakens. You have to pay attention at the same time to whether the emerging economies and China, etc., are increasing their debt in US dollars. I put the other day, for example, a chart of the increase in debt in US dollars of China relative to the reduction of its reserves. So its dependence on the US dollar is rising, the same with emerging economies. And that's why my view of the US dollar is that into 2021, instead of seeing it weakening, we're going to likely see it strengthen, particularly relative to the euro. Because the euro last year, 2020, strengthened because its trade surplus ballooned thanks to decent exports, but collapsing imports. No?
Mhm.
And therefore, the demand for euros internal in the eurozone and the trade surplus of the economy made the euro strengthen. That reverses in 2021. On one side, the growth of the economy is already disappointing. Second, exports pick up because of the global recovery, but imports soar, and therefore you have a weaker euro, particularly relative to the dollar. Despite the fact that the Federal Reserve was going to continue to inject liquidity and continue to purchase assets, because the issue with the dollar and other currencies is that this is not a game of who wins, but who loses first. So yes, the Federal Reserve's monetary policy is crazy or is very aggressive, but it's not even remotely as aggressive as the one of the European Central Bank or and particularly of emerging economy currencies relative to the real demand of those currencies. Because some people may say, well, the Central Bank of Brazil is not increasing money supply as fast as the US Federal Reserve is doing. Of course it's not. Now check the global demand for reals and check the global demand for dollars, okay? And then you see a completely different picture.
Right. Absolutely. And it's interesting because our money velocity in the US, money velocity is extremely low.
Yeah.
And I mean, that doesn't necessarily at all. In fact, it kind of contradicts the reflation inflation narrative. And I mean, do you see M2 velocity, for example, skyrocketing or at
No.
least even churning over a little bit?
It will tick up because of the base effect. It will tick up because of the base effect of the shutdowns. You know, we're going to live between March and May. We're going to live a period in which economic data is going to be insane because you're comparing it with zero in some cases. No? So we're going to see a pickup. Absolutely, we will. But it's going to be a false pickup because of the closing of the economy. You see what I mean? So the problem that I find in terms of increasing money velocity is that I come back to the point that quantitative easing perpetuates overcapacity and reduces the capacity of the economy to get into that process of creative destruction that crisis generate in many occasions. No, so you have smaller and shorter crisis, but the recoveries are slower, weaker, lower productivity, and lower inflation. So I think that we'll see an inflationary pressure from the base effect of 2020, and then a deflationary pressure into the second part of the year once the increase in money supply converges with nominal GDP.
All right, perfect. So with that being said, where do you see full cycle investors? Where should they have their money put into?
Well, I think that what this crisis and the past 10 years have shown us is not to fall into the trap of the classic case of something that has underperformed. We need to buy it because that will converge to what has outperformed. The winners become bigger winners, the losers become bigger losers. And so we are long-term investors, and we have to be 100% of the time invested. Therefore, we don't pick bottoms or peaks. We just try to have a portfolio in which we have some defense and some attack. No, so what we have is basically exposure to the technology, sustainability, everything that has to do with long-term trends, demography, etc., and healthcare on the attack side. And what we have is gold, the dollar, and exposure to US investment grade debt as defense. No? So that's basically the way that we approach our investment criteria. You might say that some things contradict others, but our objective is basically that when the market has a correction, that we have some cushion with those defense mechanisms, and that because ultimately this elevated level of quantitative easing and of monetary injections that we see globally is going to continue to lead to multiple expansion, and again, the winners become bigger winners and the losers become bigger losers.
Right. Right. Well, unfortunately, for time's sake, this would be an appropriate time to cut it here. Well, Daniel Lacalle, everyone, it was extremely big pleasure having you on. What an informative session here. I really appreciate it.
Thank you so much. It's been an absolute pleasure. Always good to talk. Have a great day.
Thank you. You too.
Bye-bye.